Joe's Shoe Shack is a retail business that provides affordable shoes such as sandals, sneakers, work boots, etc., which are ordered from China, Argentina, and Japan. Our other supplies also include shoelaces, socks, gift cards, and loyalty rewards programs, and sneaker balls, which are used to make your shoes smell better. Not only do we sell shoes, but we also offer the service of repairing shoes, which include replacing zippers, soles, and much more. We are located in a strip mall off of Route 66 in Miami, Florida. Our advertising is done on billboards, social media platforms, and printed ads in the local newspaper. Our transactions consist of the following accounts: cash, supplies, prepaid insurance, equipment, accounts payable, unearned service revenue, salaries and wages payable, common stock, retained earnings, dividends, service revenue, salaries and wages expense, supplies expense, rent expense, insurance expense, and advertising expense. Throughout the month of January, we documented the following transactions. On January 1st, stockholders invested $10,000 in cash to own stock in Joe's. On January 3rd, Joe's paid $800 in rent to the strip mall. On January 5th, Joe's paid $50 in cash for advertisements to Bob's Billboard Company. On January 8th, Joe's purchased $500 in cash cleaning supplies on account from John's Supply. On January 11th, Joe's received cash for future shoe repairs for $15,000. On January 13th, George, Kevin, and Phil worked for $1,000 and got paid on account. On January 17th, Joe's purchased prepaid insurance and $600 in cash. On January 21st, Joe's bought a bulk order of shoes for supplies in cash for $1,000. On January 22nd, Joe's declared and paid $700 cash to stockholders. On January 25th, Joe's purchased a new cash register, $300 on account.
We entered these transactions into the general journal, then entered each account into the general ledger. Finally, we took each account's balance and put it into the trial balance and totaled up both debit and credit balances to ensure that they would be equal. At the end of the month, we then had to document adjustments made into our entries, such as after inventory, we found $500 worth of unused supplies left at the end of the month. Though we were paid $15,000 in advance for providing the service of repairing shoes, we were only able to complete $10,000 worth of our service, leaving $5,000 of service revenue to be unearned. Employees earned $500 worth of salaries at the end of the month, but has not been paid yet. We then had to take the adjusted entries and put them into our general ledger. From the general ledger, we took our adjusted balances and put them in the adjusted trial balance, and again had to make sure our debit and credit balances equal. In our income statement, our service revenue equaled $10,000, and then we added up all the expenses. The expenses equaled $3,400. To find the net income on the income statement, we took our service revenue of $10,000 minus the expenses of $3,400 to get a net income of $6,600. In our statement of retained earnings, we had a retained earning of 0 at the beginning of the month, and then we added our net income of $6,600. After that, we subtracted our dividends of $700 to get our retained earnings at the end of the month to equal $5,900. In the balance sheet, we added up all of our assets to equal $22,700. Then we added the liabilities to equal $6,800. After that, we added our stockholders' equity to equal $15,900. We then added our liabilities and our stockholders' equity to equal $22,700, which came out to equal to our assets. We ended up being a growing business with a net income of $6,600.